starting off the day, as I pointed out, 60 points higher on the Nifty. Sensex also a quarter percent higher. It's it's the advanced decline ratio, which is very strong. 1,400 stocks advancing to almost 200 declining, and that's the reason there's an outperformance yet again in the small cap index. So while the Nifty Bank, Nifty and Sensex had hit record high yesterday, the small cap hadn't. Looks like today it's actually catching up, and we are likely to see that bit of rally today. Let's see whether it continues on the heavyweights, the likes of HDFC Bank, Infosys, because these were the names that were doing well yesterday. Is that something which is continuing today? ICICI Bank is something which is leading from the front, and you also have names like Reliance, etc. perking up a bit. From the broader market, not many movers to be honest. On the gaining side, just pull up a Suprajit, a Hindustan Copper, CESC on account of that antique upgrade, 5-star on account of that damn capital note and the 1,000 rupees target price. Hudco, which has actually had surge around 10% yesterday on that 14,500 crore tie-up, is building on to gains, and Canara Bank too. Their Canara Robeco AMC has got the in-principle approval from the board to get listed separately. So there is that value unlocking that people are factoring in on that one. On the losing side, Zomato is down 3%. Biocon has started on the back foot, and 3M India is also retracing a bit. But from the broader markets, I don't see any other big mover as such. Maybe a KPI Green and a BL Kashyap, but not really big movers. Just a very broad-based move that we have at our hand when we are starting off the trading session.
Oh yes, indeed, broad-based it is, with the frontline indices as well holding out along with the broader markets, and some of the names though that are bucking the general trend within the broader universe. Well, take stock of a Biocon, Indocount, CEAT, Bharat Dynamics, Bombay Burma, but otherwise Coal India, Hindalco, UPL, all of those stocks clearly doing the heavy lifting. What are the first trades? Our chartists are punching in, and 21,720, Kunal. What is it that you make of the start to the markets on expiry day and your top trades?
I think it's a good start, and I think historically we've also seen that whenever the index opens with a mild bit of a gap up, the expiry tends to be on the same trajectory. So hopefully we would be looking at higher levels than 21,700 for the expiry. In terms of opening trade, I'll still go with the mid-cap name CESC. I think it's a very attractive chart. The stock has broken past about the previous swing highs of 126. So that's a trade which I'll be looking to do in the open.
What about you, Naresh? What's the opening trade that you are spotting?
So continue to like SBI, that should be a stock which could break out about the 655, 660 mark. So buy at current levels as well.
All right, so let's go across to Samir Arora, founder of Helios Capital, who's joining us now to talk more about markets. Good morning, Samir.
Hello, Ji. Good to see you.
Good to see you. Good to see you too. I mean, see, what a nice place you are sitting in right now. You also don the hat of FII. So everybody is waiting for FIs to resume their big buying January onwards. They have not participated in dollar crack.
No, this year they have. This year
partly, but not wholeheartedly. And MF as well. Of course, you are Desi boy as well. So you actually on both the sides. But do you expect this inflow to accelerate from the FI side into India in Jan onwards?
So over the year, 100% that the number should be better. I mean, 100% is high probability. Nothing is 100%. But the thing is that generally this 20 billion or so that I think we've got this year is also a good number, because last 1.5 years, there was actually outflows of 30 odd billion. So when when domestics were buying, foreigners were selling, and the dream scenario is that both will buy. And that is very reasonable to expect in next year, because people always look at last 2-3 years performance, and that India has done well in absolute and relative. And secondly, they are still a bit upset with China, and that allocation, some part of that could flow to India. Plus in India, if they are looking for political certainty ho gayi, and also that the US rates are being cut. So therefore, in general, they'll be more bold in investing in outside US and in emerging markets and non-dollar. So from all those points, it looks that the flow should be good next year, yes.
Okay, so case for strong flows next year. The other thing I wanted to talk to you about, little macro, a bit gyan, but I wanted to understand the importance of it, which is that dollar index is cracking big time after topping out at 105, now below 101. In fact, US is not. So how does it really impact flows to EMs?
No, it generally, when the Then if you're playing a non-dollar trade, that means you'll go to emerging markets because then you are not worried so much that the currency will give you losses if you invest in non-dollar. So as soon as interest rates peaked or the feeling came that now rates should be cut, the dollar index started weakening. But in India, we are not getting that benefit, which is a bit sad for us as foreign investors, that the Indian rupee is pegged more to the US dollar and not to the US index. And therefore, if you see this year, we could all the other currencies have gained, but India has not. But hopefully, also it means that it won't, because we in the end count our NAV in dollars. So as long as it doesn't depreciate against the dollar on a bad day, then it all doesn't matter. But the point is that as soon as the dollar currency, the dollar index starts weakening, basically big picture macro is that you are willing to invest or are already investing in non-US assets. And that is why that is happening. Or because you're expecting that the US rates will be lower, and therefore that also makes the dollar less attractive compared to other countries which may have higher carry. Other currencies which may have higher carry.
Sure, point taken. I would love to hear your picks and thoughts about 2024. But before that, Sameer, I want to hear about what are you doing on New Year's Eve? Where are you celebrating that? What's the plan?
Actually, I always celebrate before because Singapore is such a nice place that on New Year Eve you should be in Singapore. It is well decorated. It's beautiful. You don't have to deal with crowds. And this time to January 1st is a working day. So it will be somewhere in Singapore only, not some jazzy location out. But Singapore itself is a jazzy place to be in.
Actually, I take that as an invitation. We should also probably get to spend some New Year's some time because, I mean, first working is something which is just very deplorable. And
yeah, really. But I heard COVID cases are picking up.
Actually,
in
Singapore is closed, but India is open. Otherwise, Singapore is solid.
Oh, it's a holiday in Singapore.
Oh, I think
Envious.
most of the places actually have a holiday except
Every
India.
normal place will have US as a holiday. Everybody has a holiday.
If anybody from SEBI is listening to us right now, please take this request on board. First should be a holiday. It's just
Pointless.
I know, and I think volume is also
Actually,
usually
in
low.
India, we work on Diwali also. Whatever you call it, Muhurat,
Yeah,
trading,
I mean-
trading, but it's on.
Yeah, we crib about it, but can't really do anything much about it.
But okay, now coming to the New Year picks and before stocks, okay, let me take some of the New Year picks from your reading list as well. An avid reader, what is on the radar, Sameer, this time?
So first of all, on the picks or on the books? Books I'll come to later. On the pick, my first fear is that January will not be good. Because, every time we come into a market with high optimism and total excitement, and that it's always disappointing. We want our first month to start well, and I hope it does. But I have this feeling that the results in some sectors will be truly bad, like in IT and also in many consumer areas. Now, whether the market can handle it and say, like it did, let's say after demon, that doesn't matter. We have flows coming in. We are looking 1 year ahead, 18 months ahead, even though the numbers might be bad. This time that I am not sure that whether the same thing will play out. I am going to be a bit circumspect in Jan if we can handle the bad results well as a market. Otherwise, it'll become very sort of, market where again we say stock specific, but first at a market level, you want the market also to do well. But to me, I think some of the hype is a bit too much. And you can already see signs of that cracking up. For example, IPOs which are oversubscribed 70, 80 times, if they are opening 10 and 20% higher, the end game of this is somewhere near. And I really believe that some of the consumer companies, consumer durable, consumer discretionary, all those other than auto and IT will be really bad. Let's see.
Fair point. I want to talk to you about one sector which again we are getting very mixed feedback about is the cement space. I mean, we saw massive rally in large cap, mid cap. You have a cement play. You somewhere or the other you are rallying also on hopes you'll be bought out by a bigger player. But when we speak to analysts on the street, they are saying, boss, on ground things are not so hunky-dory. In fact, prices are down.
We also agree. Now we don't have any cement play. And cement, this thing is down. And actually, we never used to buy cement. We had bought this Abuja as more an event around the issues of the Adani group in Feb. But otherwise, in my previous 25 years, I may have not owned cement even for a day, perhaps. So we are not very much into it, and I normally don't own it, so I can't say that currently I don't own it. So it's a big statement. So don't view this one like that.
Did your Ambuja play now?
Sorry.
You have exited that Ambuja as a play,
Yeah.
tactical play. Okay, great.
Because that was a trade around an event. We are not into cement and all these things.
Clearly, but
The event played out.
But I must say that your conviction in HDFC Bank is paying very good dividends. It's almost at 90.
It's not paying, but
Hopefully it will.
highest confidence I have today is in financial sector. And in that, all these 2-3 stocks, I hope that now 2 years we have passed not making returns from HDFC Bank, and actually ICICI State Bank also not a lot. I think this is their time, because even relatively, I think that the other sectors are going to have more result-related issues.
What about the slew of IPOs that have been hitting the market? Any take on that, Samir? Any interesting companies?
So the thumb rule in general, always when I was not in the middle of that market, is that what brings down the market is the IPOs and the number of IPOs. You look at it in 99, 2000, you look at it in 7, 8. The number of IPOs, if they increase beyond a point, generally they bring down the market, because then in the end, some few IPOs start failing and everybody realizes it's not free money. And also they take a lot of money. But here now the story every day is, oh, Indian retail knows everything. They don't know anything about it. I think people think that because you have internet, so therefore, now the people are highly informed. I think they are zero informed, and maybe they are negatively informed. And just today morning in the gym, I was seeing these CNBC Asia or Singapore was rerunning the meme documentary on GameStop and all. It was 1.5 years ago. It was the same retail, whether Indian retail, US retail. So let's not get carried away by the brilliance. I think everybody's overdoing it to be oversubscribing IPOs and SME IPOs, which have 27 crore float. You put in 70,000 crore, it does not show, or 7,000 crore, it does not show that there is 7,000 crore waiting to invest in that IPO. It means everybody knows that since it's only 27 crore, it doesn't matter if I put in 500 crores, I'm not getting it. In some of these bigger issues, you get what you want and you see what happens, which happens in many of these issues which fail in the end, that suddenly you get allotted everything or a large proportion, much larger than what you thought you will get when you put in the order. You look at these QIPs of these 2 banks that happened, state-owned banks. I mean, the issue was some 4,000 crore and they're putting in 80,000 crore. You give one hedge fund what he actually ordered and see him blow up live in front of you. Cannot be like this.
Samir, we are talking about Bank of India and Indian Bank QIP. Yeah, you're right. We are talking about Bank of India and Indian Bank QIP, not even going in SME direction.
So obscene that if one fund was actually given saying, okay, sorry, you wanted it, here it is. The whole thing that guy would go under, I think.
So actually, it is kind of a created.
That there is no size. So what I mean is, you can't force the market just with flows. You can't just say because I have flows, nobody can touch the market. The flows have to be directed correctly, or just relax. We want returns over the year. We don't want them every morning.
A very widely held myth that just because flows are good doesn't mean. And this is an artificial, demand supply mismatch being created to actually bring in a lot of participants. But it's very good that you have followed among HNI retail very widely here in India. It's good that you're bringing out in the open. So this is one telltale sign that, one should be a little cautious, not only in January, in general. Any other sign on
these things?
The ease of making money in the market, or any other sign which you would like to caution our viewers?
There's no other sign that way. The only thing we can do is see the difference. Say, for example, in US, if you see 5-year or 10-year performance of S&P, and then you see 5 or 10-year performance of, say, equally weighted index of the S&P, you can see that in the long term, they are broadly similar, but last 1.5 years, they are like 10-20% different. So, broadly over time, these things will revert, maybe not fully, but at least in the long term, it fully revert and slowly revert. It's the same thing here. You look at the performance of the mid-cap, small-cap index for 20 years, 10 years, but just end them before this rally, say end them in 19. And then you see in 21, 22, they are beating that market by 30% per annum. You know it's not possible. If it never happened in any other phase, once you took the bull and the bear or the whole cycle together, you know that if it goes so out of line, it will mean revert. It doesn't need some great PhD or something. It just needs normal looking at the numbers and saying this difference cannot be this big. Once in a while, for a stock, it can be, because that stock actually has done something. But at the full sector level, at the full class or category, it cannot be. Broadly, you know that. So just be a bit careful. Don't go there, go in the other direction. Every day, I swear, every day, some distributor tells us that why are you not launching a mid cap or a small cap fund in India? Because now the easiest way to raise money is by doing a mid small cap fund. And I'll be able to demonstrate 100, maybe 20 baggers or 50 baggers, 30, 40 in my life, but we are not doing it. It is wrong. It is overdoing it.
Absolutely appreciate that, and it's good to put that sage advice on board. But Samir, I just wanted to shift the focus a bit and talk about India versus China. Now, this year, of course, we know what the clear outperformer is, but then there is that attractiveness in the sense that what hasn't done well might just do well, and it's very undervalued. How will you peg India versus China right now?
No, so we don't do that much, but in our global fund, just on Friday and again today, we bought on Friday and we are adding more today, Alibaba. It's trading at 8 times P and all that. The point is that, but it will be some 2-3% of our fund. I don't know so much to say that that China is better, but once in a while somebody can say these 3-4 stocks are better. But at a big picture level, people are much more frustrated. We never invested in China in any way or meaningful way, or even 1% till recently. But let's talk about these institutions, these sovereign funds, these endowments, who also have philosophical issues that you don't, because you've already over-invested over 10 years, and then you've been disappointed on policy making and this and that. So for them saying, okay, one stock is cheap, therefore I will stay, or 5 stocks are cheap, or 10 stocks are cheap, may not do it. I think India's story is that a small part of that allocation will change because of just the way investors have been treated. I mean, stock market investors have been treated in the sense that people may not mind losing money if they make a wrong decision or they go into the wrong stock, but they get more upset and frustrated if they feel that these were whimsical policies of the government or of the system, or that somebody got raided because they felt that this was some state secret, or some of their companies got hit and they know something more than what we know from newspapers. But overall, it is clear that they will not get their indexed weight in the next 1 or 2 years at least, and then we see. And the beneficiary of that is India, because the other big countries are Korea and Taiwan. And Korea and Taiwan, at least Taiwan looks the same trade as China, if there are other risks. And Korea also has similar kind of stocks and all that. So India looks the most logical beneficiary of any reduction in flows to China, and any reduction has a high probability that there will be a reduction. It doesn't have to be zero. It doesn't have to be negative. It just means the new flows, at least they have to reduce them. And that, I think, is the starting point. We are not dreaming of a situation that people will redeem from China and start buying India. That is too wild, and we may not be able to even handle that size of flows or those volumes in terms of this thing. And we don't have to go that far in our thinking or in our hopes.
But at the portfolio level, Samir, if you had to don the hat of the advisor, what would you say is the good portfolio allocation right now? You talked about China. What about US? What about bonds? What about the other asset classes?
We don't do all that. We are equity guys, so we like USA number 1 because it's just a big market.
So what in USA? Are the tech stocks or something else?
Those techs, we have 6 of the 7 techs in our fund. We don't have Apple, but other 6 we have. And anyway, that I don't manage that fund, but basically I know everything that is being done there. But broadly, USA is a good market on its life. It is just a market where innovation is there. Now, these weight reduction companies, both we have, Merck and Novo Nordisk, I think it's Merck, I forget also, whatever, those 2 weight reduction medicine companies. All this action happens there. All the starting technology, all the innovation, everything starts there. We all just copy them around the world.
Saying US over India in terms of market?
Sorry?
You're saying US over India in terms of the return expectation?
No, maybe not now, but in general, US has been very good. I mean, but the US, I'm not talking for an Indian investor, not for me. I run an India fund. So for me, India is, when you ask me that question, I am not like a fund manager saying, hey, hello, I run an India fund, put 100% in India. If I meet a foreign investor who says, how much should I have in India, or even an NRI, I don't say put 75% in India. I say normal fellows put 5, you are an Indian, you know India, you put 20. If I tell him to put 80% in, he'll think that I'm just selling my own investments all the time. I'm just think generally since US is a big market and it does well, but India, of course, we are India centric, our experience, track record, histories in India. So for us, India may be more. But I have to clarify that. If you ask me which is the best stock, I can say generally HDFC Bank, but doesn't mean I'll say put 100% in HDFC Bank. I am not sorry, like the typical fund managers who come.
Okay, so which do you believe, apart from financials, I know you've spoken a lot about it, will be the most promising sector for the year ahead? And what is one thing that you guys maybe have never looked at and will never look at as a space or a sector you want to steer
those
clear
things,
from?
we are flexible. So for example, all our life, you would associate me with saying that I don't like PSUs. And over the year, we have now 7 PSUs. We have HPCL, we have IRCTC, we have the old State Bank that we always had, we have Bharat Electronics, whatever. So maybe now there are 6 because we bought one of these QIPs and sold it off. So the point in general is, right now, if you say what we will not buy, we normally say we don't buy where government is a large customer in infra. Now let's see how long we stick with it.
In fact, sir, I want to understand your thought process for HPCL. Not only HPCL, but oil marketing companies historically have always been treated a point A to point B trade.
You cannot point A to point B trade.
So this is a point A to point B. Right.
But the difference is that HPCL now is becoming a little bit more self-sufficient in the sense that they used to buy oil from outside. Now they have their own. Secondly, they are spinning off their lubricant business. And thirdly was that we were all waiting for the fact that, when elections come, you can't increase prices and all that if oil prices go up. But then in the end, we thought that there are only 4 or 5 months left for elections anyway. And in this period, even if they get less flexibility, the market may look beyond that, saying that when the new term starts, maybe the government will be more aggressive even and maybe, selling off a little bit strategically or otherwise, and it had become too cheap at some 4 or 5 times with some 5-6% dividend yield. So we can change our mind if somebody convinces us that the mind needs to be changed.
Okay, fair point. I mean, yes, I mean, all the there was a lot of efficiencies being extracted out of PSU. Started with PSU banks. Power, so why energy should be left behind, and again the value play. Where else do you think there is scope for reform in this term or this new year by this government, where you could play a PSU theme? Do you see scope for more value still left in any PSU pocket?
I don't know, because these ones, my team has to bring. In my heart, I don't go looking for.
Sure, I'm sure.
Because generally, I was so against them all my life.
But the argument was so strong that you couldn't.
What is happening?
You had
I
to
am more
agree
interested
to
what is happening to Paytm and what is happening to Zomato. Those are my kind of history, in terms of, or Varun Beverage or something. But I am not inflexible.
Sure. That's how a fund manager or somebody who's heading such an organization should be, isn't it? But Samir, are you looking at pure metals, commodities, aluminum, steel?
Again, we don't look at those. We are not easily, and that even in my team, nobody really looks at it. Every day we have a morning call. We don't talk about it.
So how long can this, winter for consumers last?
Outside our normal range of going into PSU, but now metals is one more level of macro thinking, which is beyond our simple brains.
Since you look at India so closely,
if you think that China is doing badly, if you think China is slowing, if you think the world has spent too much money, that the fiscal deficit of the world is high. Big picture is not so exciting.
Okay, I want to know your thoughts on consumers, because pure play FMCG have been having a weak quarterly numbers for several quarters now, as in to the extent that they have stopped commenting about the outlook now. When will it? But mean reversion is something which happens, right?
No, but mean reversion doesn't happen just like that. Mean reversion, they should mean that they are doing well. See, why we say that HDFC Bank or ICICI Bank may do well, I mean, as a stock, is because otherwise we know they are doing well fundamentally. Therefore, the preference of the market can change. But you can't say that a stock is doing badly, but its mean reversion will happen when it has not become cheaper. Like say for IT, why do people talk about that the IT might pick up? Because the IT stocks show that there's already a pickup. The IT stocks are up 30, 40, 50%. If you see the performance of most of these mid-cap ITs from 2019 December to 2019 March to now, so that pre-COVID, and you say what is their earnings growth cumulatively, it'll be in the range of 60% to some 100, 120%, and the stocks are up 4 times, 3.5 times, 4.5 times. So you know that what reversion, this thing that the next year will be better, because at best they're all talking about 8, 7, 10% growth in 25 over 24. For that, these stocks are already up this year 20%, 30%, 40%. So I don't understand why people keep saying that IT might recover and IT might this thing for next year, which is lower than our GDP growth in nominal terms. But that you can say some reversion if a guy is doing well, but the market is ignoring it. If the fellow is doing badly, the mean reversion may not happen. Also, if you see some of the other stocks, the big names, which were really expensive, their numbers are okay, but nobody cares anymore, including the biggest finance company in India, because it became too much. So that needs time to absorb, time to consolidate, and that could be 2 years, 3 years, 1 year, whatever.
Samir, before we let you go, that question on books, and are you a guy who believes in New Year resolutions?
No, I don't believe much, but these days I am a very reformed fellow. So whatever resolutions people have, I'm already doing. I'm exercising. I'm not eating desserts. I'm going to the gym. What is the 4th resolution? I've never heard anybody make. So
less phone time, less social media. Are you addicted to your phone? Then maybe less time.
That I don't consider that as actually, according to me, Twitter.
No, but are you addicted?
Twitter saves me time. So because, for example, previously, if I had some fatta, I had to call 10 people and tell them, I thought of this. Now I can just pull anybody's leg and off it goes. It just saves me time.
Good thinking there. But on that note, we'll let you go, Samir. Good to be speaking with you, and have a happy 2024 in your perfect avatar.
As a reformed person.
Okay. Let's take a look at the markets as well. It's Hudco, which is actually gaining ground, 8% higher. Yesterday, that stock was up around 10%. That 14,500 crore tie-up is something which is definitely got the street excited. So that stock is 123. Hindustan Copper for the second straight day is also running quite fast, 6.5% there. Honeywell, Galaxy Surfactants, Just Dial, Torrent Power, these are some of the other names. And on the losing side, Zomato, HFCL, these are some of the names which are on the back foot. But time now to slip into a very short break. Don't go anywhere. When we come back, we'll be joined by the management of Aarti Industries, a big 9-year agreement that they have signed with a potential of 3,000 crore. How exactly will it pan out? We'll decode with the management on the other side.
All right, so now we are starting a discussion which the street was really awaiting for a very long time, including us. And we have the management of Aarti Industries, one of the leading companies in the chemical space. Rashesh Gogri, Vice Chairman and MD, is joining us now. Mr. Gogri, morning. Thank you so much for your time. We were really looking forward for this chat on a variety of reasons. Last 1 month, we are witnessing, I'll say some change of heart by the market. Chemical stocks are witnessing buying, and certain parts of the market have started saying that probably the worst for this space is getting over. The long winter, almost 3-4 years. Issues such as pricing competition from Chinese players and dumping by Chinese players in the international market, due to which Indian companies have a lot of issues, is ebbing now, is reducing. plus upgrades coming in for your own company and many others. So before we go to other points, I want to understand where does the situation stand for Indian chemical exporters from Chinese competition and volume dumping in the market.
Yeah, I think last 1.5 year we had seen a lot of compression of demand and basically destocking happening from the international buyers in various segments, and that of course was a story which was supposed to end at some point in time, and we are seeing a gradual change where global players' inventories are now getting in control, and we are seeing in the discretionary side some demand uptake. And also, I think agrochemical is going to take a little more time for it to come back to full volume potential, probably another 2-3 quarters. So that is how we are seeing little positive going forward in next 2-3 quarters. I think everything should bottom out and the demand should come back. Once the demand comes back, then we will have the pricing power also, and the profitability will follow later.
Okay, point taken. Sir, my colleague actually broke the news flow that perhaps the global company that you've made this tie-up and this big 9-year long-term tie-up is actually Bayer. Could you confirm that for us? And also if you can talk to us about in terms of the revenue potential we know is around 3,000 crores, but what will it do to your profitability and what kind of margins you expect to garner on this one?
Yeah, so for the confidentiality reasons, we can't name the company, but as far as the overall potential is 3,000 crore revenue, as you know, and it is going to be EBITDA of about 20%. So that is what the guidance that we have for this contract, and it is a 9-year contract on a herbicide agrochemical intermediate that we have signed with the company, global company.
And when will it start showing into revenue? From Q3 on or Q4 onwards itself?
Yeah, so I think next year we will start the supply. It's potential supply, and it will be a ramp up in 24 and 25, and then it has a full potential going forward.
Okay, fair enough. Let's also discuss the global client that you've tied up with and get in a sense as well from you as to what the outlook is on the new capacities rather, because no new capacity has come in as per your press release. So you were already supplying it. So if yes, can you just tell us what is the outlook in terms of your revenue as well as EBITDA guidance for FY25?
Yeah, basically what we have done is for this product, we have already gone for an expansion and which will help us cater this customer and the expansion is coming on stream, next year. And in terms of the guidance, I think we have given FY25 guidance of 1,700 crore, but I think looking at the overall market scenario and the position, we are looking at 5 to 15% lower than 1,700 crore, which was our earlier guidance, but we will be up quite a bit from the current year.
Mr. Gogri, the other point I wanted to just go back a bit on that. I remember almost 4 to 5 quarters back, your company had come out with a very detailed view and message to the community, the investor community about your capex plans and also how you want to you're adding gross block and of course wanting to take your revenue and profit 3-4 times by 27. And then this peak pessimism in the global market and industry went. You have not changed that at all so far. So which means you are holding on to that visibility of the revenue and profit growth which you had given.
Yeah, so basically we had guided 2 things. I think we had guided FY25 guidance was earlier given 1,700 crore, and then we had also guided 3 to 4x by 27. So I think what we are doing is currently our projects are ongoing and we are planning to invest 2,500 crore in next 2 years. And with this expansion in the chlorotoluene value chain that will be ongoing and coming on stream partially in FY25 and then in FY26, we are pretty confident that overall the situation, macro situation also will improve. And currently, it is very difficult to exactly pinpoint the number, but I think we are pretty confident that the revival will happen and we will be able to do well.
Mr. Gogri, I also wanted to get a sense from you. These large order wins, and we've heard it from a lot of other companies as well. There are these global tie-ups which are happening. What do you think is the reason behind that? Is Europe plus one or China plus one coming back with quite a bit of bang? And overall, for your capacity, what kind of utilization levels will be there a couple of years down the line? Do you have the capacities already tied up, or there could be further orders that you get? That's what I'm trying to get here.
Yeah, basically, as you rightly mentioned, the current change is Europe plus one or China plus one. That is where the traction is coming. Global majors are looking at cost rationalization and also geopolitical risk rationalization, and due to which they are looking at India, because India has the potential to serve them with the chemistries that they are looking at. And I think overall, we feel that India is in right position, and our company particularly is positioned to cater to wide variety of market, not only in agrochemical, we also cater to polymers, paint and dye stuff, and all kind of other intermediates also. So we are in good position to grab the attention of these global majors who are willing to look at potential partnership outside of the current regions that they are operating. And to your other question, can you repeat, please? Thank you.
Sir, was on the capacity utilization, and are there any such large orders in the pipeline as well, wherein you are in talks already?
So on the capacity utilization, we are already we have expanded in our current value chains that we have, and we will see ramp up of that utilization happening in next 2 to 3 years, and we will be quite occupied from 85 to 90% in our current capacities that have been expanded in last 1 or 2 years. Whereas the new expansion is happening in the completely new value chain, which is in chlorotoluene and the other multipurpose blocks that we are putting up. And those will have more ramp up, because that's completely new value chain with more than 50 plus products which have never been made in India and first time in India. So those will have some ramp up time, but there we are putting up completely downstream along with the base products. So we will have the full value chain at one go. And that's why we feel pretty confident that we will be able to service the market and come with global size capacity on very early in our start of this segment.
Mr. Gogri, just before we wind up our interaction, just a quick view that the chemistries you're operating in have decent, upwards of 20% margin profile, which you have already shown in many of your interactions and even the new tie-up. That is unchanged, and you are holding on to the view that destocking and pressure on pricing in the international markets is likely to ebb out or bottom out in the next 2 to 3 quarters, as we look at things currently.
Yeah, basically currently the EBITDA have compressed. Definitely, you have seen last 3 quarters. There have been a lot of pressure overall from the China, and overall demand slump has resulted in overall margin pressure. But I think longer term, we feel that as we do more value-added product manufacturing, I think we will be there at this kind of number of 20% plus EBITDA for any new addition of products that we do, because we are going for a higher value addition products, be it in agrochemical space or polymer space or any such end market segment.
Okay, and I wanted to also understand, Mr. Gogri, the outlook on your net debt, because as of September 23, I understand it's at about 3,200 crore rupees. What is the peak debt that you're looking at? What is going to be your debt status for the next couple of years?
Yeah, I think we have an cash also generation which is happening for this year, next year. And looking at overall, I think currently we are at 3,200 crore. We will slightly increase the debt, but I think it should be under 0.7 debt equity. That is what the level that we have with the board, that we don't want to go above that and be reasonable in terms of servicing of debt.
Okay, Mr. Gogoi, on that note, we let you go. Appreciate you joining us on the show. So
Thank you.
that's the latest coming in from RT Industries. Holding on to their guidance, one of the large orders which I have bagged, almost 3,000 crores for a 9-year time period. The margin that they have on this one is 20%, and perhaps there's a lot more in the pipeline as well. Quickly, just wanted to mark a few more stocks, and I'm repeating what's happening on Hoodco because it's up around 12%. BHEL is the other one that's actually spiked 4%. Techno Electric higher by 4%. BSF India, Spandana Spurti is also seeing decent amount of volumes right now. On the losing side, Policy Bazaar is actually seeing a bit of a cut. You also have Zomato, which we've been talking about, has been down in the trading session. So a lot of these movers in the trading session. But what's a chart buster idea at this point of time, Kunal?
Well, that's from one of the...
Okay, I think before we go to you, let's go across to Naresh to get his view. Naresh, the chart buster idea?
So that would be a stock for DCB Bank. Now, we've seen a strong trend across the banking names with the large ones as well as the small ones. DCB Bank has gone through a sideways consolidation for the last 1 year, a triangle formation, gave a breakout above that 125, 130 mark. Very strong volumes, went up to 135, did a retest of that 125 mark, and is now making a comeback. So the volumes in the last 1 month have been higher than the last many months. That's an indication of good accumulation. Expecting this to break out going forward. A stop loss at 120, target price of 150 to 180 in the short term.
Watch out for DCB Bank. Charts are trending well. Let's find out then what Kunal is picking out, and it's another banking stock, Kunal.
Yeah, it's a PSU banking lot. Yesterday we were recommending Bank of Baroda, Canara Bank, and PNB is apparently one of the other stocks which is heading towards a breakout. Now, interestingly, the stock has been a huge underperformer. So, it's interesting to see that the stock was almost 200, 250 levels in 2018-19. And from there, the stock had fallen down to, I think, as much as 20, 25 rupees over here in 2020. Now, what's actually happening is the stock getting into a resurrective mode. As you can see, the stock has come back towards a trending mode where it's forming a pattern of higher highs and higher lows. Interestingly, the first level of breakout for PNB is closer to this major resistance, which is the 3-digit mark for the stock around this 100 levels, and post that it's actually a resistance-free zone for the stock price where it can move to even 125 to 150 in a very short span of time. So the stock is now currently placed at 94 levels, which means that the first hurdle should be placed closer to 100 levels for PNB, and above this breakout is where we expect the momentum to accelerate for the stock price. So should be a clean chart for the stock over the medium to long term.
Right, medium to long-term charts looking promising for PNB. Let's find out then what the top trading calls are from our chartists. Naresh?
So first is a buy on Kotak Mahindra Bank. First indications of relative outperformance, getting towards that target of 2000, which is the major resistance, stop loss at 1880. Second is a buy on Apollo Hospitals, a new 52-week high, still away from an all-time high. Could catch up with the rest of the hospital space. Stop loss at 5670, target price of 6100.
Point taken. So those are some of the recommendations coming in from Naresh. Kunal, what about you? What are the individual bets?
So I'll go with two buy calls. The first one is a buy on BHEL. The stock looks attractive in terms of momentum, so would look out for 200 as a fresh target for BHEL. Stop loss could be trailed hard to 184. And the second would be a buy on Axis Bank. That stock is also bouncing off from that 1100 support. So would suggest a buy with 1160 as a target. Stop loss at 1080.
Okay, there you have it. Those are some top technical recommendations. But the chat about levels, markets, stocks, all that continues. We've got Gautam Shah now joining us. He is Chief Strategist at Goldilocks Premium Research. Gautam, hi. Looking at your latest report, it says new highs is quite a feat. But going by what you've, put out in the report, you're talking about the Nifty Bank and IT sector batting for the bulls, and therefore it becomes easy for the Nifty to rally. So given the kind of rally that we have seen at 21,700 levels, is that going to only sustain as per your analysis?
Good morning. Well, when we put out the message that new highs being quite a feat, we meant after what happened last Wednesday, because there was so much talk and chatter around the market fall of a single day. And this really reminds me to what happened in that 2003-2007 bull market, where we did see these knee-jerk reactions from time to time, but it only helped the market set up. And the manner in which the indices have come back in the last 4 trading sessions, it just tells you that the bulls are still in control. Momentum is strong. The participation has been excellent, and support levels have been respected all along. We put out that number of 20,900 based on moving average studies, and quite amazingly, the index moved up from there. Now, as things stand, things are a little euphoric. I think we have reached a phase of exuberance, and there is this feeling in the marketplace that this will continue forever. But I do believe that as we get into the month of January, be prepared for some volatility, some weakness, some correction. But I think it's going to be rotational in nature. On the Nifty itself, our working target is about 22,300. So as we get close to that number, I think it might make sense to take some profits off the table and maybe work with a trailing stop loss of 21,200, or even if somebody's comfortable, 20,900. So while the index might not be so relevant right now, I think there are opportunities in a lot of sectors: banks, IT, pharma, metals, infra, power. I think that's where one should focus on without looking at the index much.
I just wanted to scratch that point further. When you say 22,300, Gautam, what's the timeline of it? And there's this raging debate in our studio how January is going to pan out, because historically it hasn't been a great month. It's been usually negative. But for now, the momentum that we are seeing suggests something different.
Well, as you rightly pointed out, I think seasonal triggers have worked well. If you look at the track record of the last 25 years, November and December are generally positive months, and it's played out beautifully in the last 7 weeks. And as we are in the last week of December, this is usually the feel-good time. This is usually the time when FIs are on a holiday. But as we get into the month of January, and with earnings and with a lot more discounting, I'm pretty sure that it's going to be volatile, and January is not likely to be how November and December have been. So I think keeping that in mind and keeping the breadth triggers in mind, just to put a statistic, 92% of the stocks in the NSE 500 are trading above the 50-day moving average. When you have such stats, it just tells you that the market is indeed very, very overbought. So while this might continue for another 2, 3, 4 days, but I think starting the 7th, 8th, 10th of January, you will definitely see some pullback. So stay prepared. But if you are in the right stocks, in the right themes, because this is a market where one theme picks up, like look at what has happened to chemicals. It's a basket that has come back so strongly in the last 1 week, and we see a big opportunity in chemicals in the next 3 to 6 months. So just stay in the right themes without really bothering about the index.
Interesting point you made, chemicals. I mean, we were speaking to Rashesh Gogri, chairman of Aarti Industries, just before talking to you, and he was also saying next 2 to 3 quarters is where he's expecting things to rebound, destocking to happen internationally, and margins come back. So they have not changed their capex guidance or revenue guidance despite of what has happened in the last 2 years. And now you are mirroring the same sentiment on the leader stocks at least, but basket is the right way. What would you do in metal stocks, Gautam? Because they have also come back with dollar index cracking, steel, aluminum, everything is rallying right now very nicely. Would you back any of those ideas in the metals? How would you approach metals?
We would actually approach it very strongly. Metals have seen a sort of a pendulum or a seesaw kind of a move the whole of this year. There have been phases of strength, and then there were phases of a lot of weakness, which scared people with their performance. But this comeback of the last 1 month looks very genuine, and we have actually turned quite positive on metals. JSW Steel has been on top of our radar for a long time. And we particularly like Nalco. I think it's a stock that we recommended, and we feel it can do bigger things even from current levels. And mind you, these are stocks which are coming out of 3-6 months of consolidation. For that matter, even a Steel Authority of India, what a smart move it has seen in the last 2 to 3 weeks. And there is a lot of catch up. You compare this with some other PSU names, you'll see that once they ended their consolidation, the move was very large. I mean, case in point being Coal India, NTPC, Power Grid. Something similar might happen to a stock like SAIL. So metals is something that we are very positive on. Tata Steel also, I think, offers a great opportunity, limited risk of about 10 rupees on the downside, and upside potential of 30 to 50 rupees. So that's a good 1:3 risk reward to play with in many of the metal stocks.
Gautam, what about the banking index? Was it rank underperformer? This series, it's managed to turn its head around. Do you expect this momentum to continue? And if yes, what are the constituents of it which you think will drive the rally now?
Did you ask me about the IT index?
Banks.
Okay, so, the screen always lights up when the banks do well. I think that's something that we've seen repeatedly in the last 1 year. Bank Nifty underperformance ended a month back. That's when we actually turned bearish after being cautious on it for about 3 months. Our working target was 48,000. We are right there. I don't think this Bank Nifty rally is going to end anytime soon. We are looking at an eventual target of about 49,100 and possibly at some point of time in the first quarter of next year, even a 50,000. Why I say this is because the top private bank, which is SDFC, is looking solid on the charts after a long time. Hopefully, it moves to 1800 plus in the current move. And the top public bank, which is SBI, has a phenomenal setup. In fact, it's one of our high conviction buys at these levels. You know, a couple of years back, we actually found out ITC for our clients. Then we spoke about Coal India. And now our high conviction bet is SBI. I think it can do something special in 2024 if you want to just pick one stock among the large caps. So given this view, I think the banking as a space should do well, and that should keep the entire market safe. You know, if the banks are strong, the Nifty is strong. If the Nifty is strong, generally the entire market is steady.
Gautam, you know, let's dissect some of the other specials on the kind of stocks in the broader market which are making some big moves and not very wide representation. For example, battery stocks have started coming back. Amar Raja, Exide, just 2 battery stocks, such a big auto market, plus the export opportunity. Look at how lubricant stocks have come back. Only 2 pure play lubricant stocks, such a big auto market, and plus lubricants have, you know, their application beyond auto as well. Have you had a chance to look at some of these on the charts?
Ajay, that's exactly the point, that you have to look at things as themes. And I think we've actually seen auto components as a major story. Auto ancillary and auto components, I think they've done very well as a basket. In fact, auto as an index continues to be very strong. Look at Tata Motors, look at Bajaj Auto. And I think auto components and this entire EV theme, which was so widely discussed a year back, is now coming in favor. And I think this trend will continue because many of these fundamentally strong underperformers of the last 1 year are now coming back, and that's exactly, you know, where we are picking our names. So just to put it broadly, auto components looks great. I think there is more upside potential. And construction material, we actually put out a custom index for our clients last week. So while real estate is already done well, but now the construction material index, look at Green Cap Panel, Kajaria, ceramics, all of these stocks have a very good setup. So you have to be very stock specific in this market, but just ensure that be in stocks which have high institutional interest, because there's so much money coming into mid caps and small caps, 8,000 crores every month. I think that will propel many of these stocks higher and they will get re-rated along the way.
Okay, that's interesting. What would be your outlook then when it comes to some of the, niche players, maybe stocks related to the fertilizer sector? Sugar has seen an interesting up move, agri or rural related. Is there any, any trends or any stock specific calls here?
A lot of opportunities. I think fertilizer has been on top of our list. We in fact covered Chambal fertilizer. We have been batting for GNFC. We recently covered Deepak fertilizer, and I see all of these stocks doing well. Again, if you look at the numbers, it's all excellent, fundamentally, quite cheap as well, under-owned to a certain extent, and they're all now breaking out relative to the Nifty. So fertilizer, we continue to like. Sugar has been volatile given the government news flow from the government. From time to time, it's not been able to pick up, barring a few stocks. So I'm not very sure there, but I think some other names which we like is cement. I mean, look at an Ultratech, Ramco Cement. They've all seen massive moves, and I think the best is yet to come. So cement and power and infra, I think, are basically proxies to the India story. And not to forget consumption. I mean, consumption of services and consumption of products, as an India story, has come back very strongly in the last 1 month. Many stocks have made a strong comeback, and I think this is also going to flourish in the months to come.
Gautam, your view on the power stocks? I know at one point of time you were quite bullish on Inox Wind. What would be your call on that one now? And even the other power names, the power financiers, for instance, had seen quite a bit of run up. Would you now recommend people to book profits and churn into other sectors, or just continue holding?
That's exactly the view. We are recommending people to take profits in stocks that have given you massive returns in the last 6 months. So Inox Wind for me is at a point where one should take profits. We are just going a little safe and conservative into January. We want to be in the conservative names. even if we make less return, it's okay. You know, everybody's running after returns on a day-to-day basis, but we are just going a little low-key into the month of January because I think the risks are slightly higher. But on an overall basis, power as a space clearly is buzzing with activity fundamentally and technically. We continue to like Tata Power, you know, the big boy. We continue to like a JSW Energy, CESC, which has made such a good comeback. But the other names that you alluded to, I think profit booking can clearly be done.
Top recommendation in the Pharma pack right now, because that too is seeing quite a bit of breakout of late.
Pharma looks great. I think it was in a phase of underperformance for about 6 months. Thereafter, the moves have been excellent. You know, some of the biggest underperforming stocks of the last 2 years have given you the best returns in the last 2 months. And this is going to continue. Our working target is about 17,000 to 17,500 on the NSE Pharma index. And I think the going is only going to get better. Once again, you know, as I pointed out, go defensive in January. So IT and Pharma are right on top of our list, and I think both will outperform. So even in the Pharma space, Dr. Reddy's, Divi's Lab, Zydus Life, Cipla, all have excellent setups, and even the mid-cap pharma stocks, you know, stocks like Solara, stocks like Strides Pharma, they've all done well in the recent past, and I think there is more upside potential there.
Gautam, before we let you go, you're part of the market, and this market infra theme is doing very well. The latest stocks to latch on to this are the wealth management stocks. Nuvama, of course, it's a recent listing, but some of the others, Anand Rathi Wealth has been around, 361 has come back. BSE is doing any of these stocks, which are about a dozen now, from the market infra theme, which look good to you?
Well, financial services is a big theme, given the rise in SIP numbers, given the fact that a larger part of the population is now into the financial markets, and thankfully so. We wish that something like this happened 20 years back, and it's now happening. Because of that, I think this entire financial services theme has picked up substantially. But don't paint every stock with the same brush, because I think when a correction happens, like what happened last Wednesday, the men will be separated from the boys. I still want to stay with the bigger names, the bigger themes. I still like CDSL. I think it can do wonders over a 2 to 3 year period. We still like MCX, which is also a proxy to the financial services theme. The wealth management stocks that you mentioned, yes, they've done well. They've run up a lot. Numbers are very good. But I think the risk reward is not justified to be making serious commitments at these levels. So again, the key takeaway is stay with the big boys, stay with the industry leaders and challengers as we get into the first quarter of next year.
Gautam, you said SBI could do some special thing in the next year. Which is the other top bet for 2024 if you had to pick one?
Well, I think a lot of new age businesses have done quite well. So I think Zomato has been on our list the whole of this year, and it's delivered supernormal returns for us. I think another stock which looks very interesting is Nazara Tech. I think a lot of the negatives are now in the price, and the stock really has the potential to do something special. So Nazara has been on our high conviction list for a while now. And I want to add to it chemicals. You know, we started the conversation with the chemical space, Aarti Industries, Deepak Nitrate, Gujarat Fluoro, SRF, alkali amines. I think all of these stocks have very limited downside and large upside potential. And I'm told that fundamental triggers will also pick up over the next couple of quarters. So, risk reward is something that your viewers need to keep in mind while they commit at a market which is at 21,500 or 21,700.
Okay, Gautam, on that note, we'll let you go. Appreciate you joining us and have a very happy and strong 2024 as well. This year has been rather kind for a lot of market participants. Hopefully that continues in 2024 as well. Okay, time to take a look at the market because we are off 21,700, but still 21,000, just around that mark to be honest, 21,700 on the Nifty. So I think we're off the highest point of the trading session, and take a look at the Bank Nifty as well as to what it is doing because 48,500 thereabout was the level that we were talking about. But of course, a lot of action in the primary markets as well of late. Yesterday's listing, case in point being Credo, RBZ as well as Happy Forgings, they're all building on to gains today. And take a look at listing of today, Azad Engineering 35% higher. We were thinking this is a bit, in the fair value zone. Ajay, it wasn't like very, very cheap as well, but clearly the street is sensing some sort of profitability there.
So I would say that at 720, it listed at around 715 or 720 or thereabout. if you take the 1 year forward valuations of Azad, they come at around 40 times. 100 crore is some 12 year forward they're likely to do. At 40 times, if you are already somebody who got the allocation, it's a great company, great opportunity size and tailwinds in the sector, you may want to book some profit and hold some. But would you want to buy just like RBZ listed at flat or Credo listed flat? Probably not. Or ADA 20%, 30% higher, but there was still a lot of money to be made? Probably not. So every IPO you have to take very carefully. This was if you got in at the right time, as in the IPO you got allocation, okay. Perhaps not to be bought fresh at 40 times forward. There are so many other stocks which are already listed in 40 to 50 times 1 year forward range. Unless you hear from the management that growth is accelerating, and that's why after 35-40% pop, it's just halted out there, I would say.
Okay, so perhaps no surprise to see that move. Tell you what, with the index at 21,704, we'll take a break, and as we do that, ET Now and ET Now Swadesh wants to help Indians rise with India. We've partnered with Sundaram Mutual to launch Nivesh Day to help investors build their personal finance portfolio through disciplined investing, which is celebrated on the 5th of every month. So learn how you can build your financial future with an SIP in mutual funds.
As the year